Hey guys, welcome to my channel. If you are currently looking at purchasing a home, or the idea of purchasing a home is a goal that you'll just never be able to reach because saving for a down payment is so difficult, then this video is for you.
Goal is to provide you with financial information that isn't gibberish. My videos are a representation of real-world problems that everyone wished they were taught in school. When I am not running numbers, I love to travel and immerse myself in other cultures. I enjoy spending time with my family, my spouse, and my adopted puppy, Harper.
We have some options on saving for a down payment. We are going to look at options for first-time homebuyers, options for people that are not first-time homebuyers. So we'll start with options for first-time homebuyers. There's an option called the first-time homebuyer incentive, and that allows the government to add to your down payment. So when you put your minimum 5% down, the government will either add 5% or 10% to your down payment, depending on what you want, depending on if you qualify, and depending on if your house is new or existing. If your house is new or currently in the building process, you would qualify for that 10%. If it is an older home or you are not the first ones to live in it, then it is considered an existing, which means you only qualify for 5%. The first-time homebuyer incentive is completely based on your down payment and your income. So if you are going to look into the first-time homebuyer incentive, the maximum combined down payment that you can have is 19%. You have to pay the CMHC fee to qualify for the first-time homebuyer incentive. When you go to pay the government back, so you can either sell your home or you can get your house appraised. If you sell for a higher amount or your house is appraised at a higher amount, then you pay 5% or 10% to the government at that higher amount. If your house sells or gets appraised for lower, then you pay 5% of that. Now, there is some exceptions. If your house goes up 200% in value, the government cannot take 5% of that new existing value. They have a cap of what they're allowed to take. So if you have also recently sold a house and had the first-time homebuyer incentive and did pay back the government, it might be worth looking into seeing what exactly you paid and seeing if you paid more than that cap, because then you are eligible to get some of that money back. And that cap was in recent, about a year or two ago. So just a heads up on that. The next first-time homebuyer is RRSP. So as a first-time homebuyer, you are allowed to take funds out of your registered retirement savings plan and not get penalized for it right away. You have 15 years to pay back the money you take out from your RSP for your down payment. And if you don't pay it back within the 15 years, then you would claim that amount as income and pay tax on it. And then for your RRSP, if you do not pay it all back within 2 years, you do get put on payment plan with the government so that it gets paid off within that 15. And if you have no plans on paying it off, then you just claim it for taxes. The next option is a TFSA account, tax-free savings account. So you can take money out of there as well if you have one. If you do not, you can always start a tax-free savings account. There is a cap depending on your age of how much money you are allowed to put in your tax-free savings account. So I would advise you can put money in it and then invest it, and your money can grow without you having to add more. So it just completely depends on what stocks you pick. The higher the risk stock, the probability of you making money faster is also higher, but the probability of you losing money faster is also quite higher. which is why you need to look at what risk you want to put your money in. It's not always going to double. It's not always going to increase. It's not always going to increase super fast. It completely depends on your stock and what the stock markets are. So I would go talk to a financial advisor on what would be the best route for you for that. Another option is refinancing your vehicle. I've had clients in the past that are just shy of their down payment and can't seem to get that extra 10, $5, $15,000. Refinancing your vehicle is an option depending on the year and how much equity you already have in your vehicle. So that would be something to look at. If that is something you are interested in, feel free to message me and I can tell you if your vehicle would qualify, kind of what you would get from that. Another option is a gift. If you have an immediate family members that are willing to give you money for your down payment, doesn't have to be all of it, it can be some of it, it could be all of it, completely up to you and your family member. That might be something to look at too. Another option is a secured loan. So if you're an individual that is having trouble saving for a down payment, but also doesn't have the best credit or doesn't have a lot of credit, a secured loan might be an option for you. Most banks have a secured loan. You're basically talking to the bank, and usually it's about $5,000 is a secured start of a secured loan. And then you have about a year or 2 years to pay it off. They give you that money, you pay the loan back. That helps show that you're good at making payments on your credit and helps build it and increase your credit score, as well as having money for your down payment. If you found this video helpful, feel free to subscribe. And also below are the links to my blog if you prefer to read all the information that was stated in this video, or feel free to follow me on Facebook or Instagram as well. Those links are also below in the caption. If you have any questions or any ideas on certain topics you would like me to cover, please feel free to write those in the comments below.